Markus, I'll start by first of all, welcome. Markus and I are, I view Markus as a very close friend, and more importantly, he's an esteemed scholar, one that I consider has made many important contributions, but is also, his contribution spans a lot of areas. You can talk to Markus from history to very technical issues about permissionless in blockchain, all the way to intermediary asset pricing and to macro. In today's very specialized profession that we have, it's very, very difficult to find people that span such a wide array and a huge range of interests, such as Markus. Unfortunately, Markus, I cannot stay. I wish I could. I will read it. I don't know what Bessenet will have to say about mission creep and unconventional. So I'm really curious because from what I understand, there's some optimality between conventional and unconventional mix. I just, I don't know if it's because of the heterogeneity that you put in or some other reasons but I think by our next meeting and after the seminar, I'll poke you on this and we can talk about it. But it was important enough for me as you can imagine, these are unconventional period for us here in Israel, but nonetheless, the team has made a stop. They can make a stop. I unfortunately have to go and do something. But I think everybody's eager to see this. This is clearly a very important issue for us in the way we're thinking about monetary policy. We have used unconventional tools, both in the FX and in the bond market, and even in other forms. So I'm really eager to hear and to learn more about it. Sometimes the problem with the unconventional part is, how you end with wars. You know how you enter, you don't know how you exit. We're honored to have you, and I will have to drop after this, but I'm sure you will get plenty of questions and discussion from the audience. But it's always good to see you, and I hope I'll see you in the next Basel meeting or something like that.
Right.
All right.
Thanks a lot, Amir. It's a pleasure, and it's an honor.
All right.
Would hope to see you soon again, Basel or or something.
Thank you.
Bye-bye.
I'll see you guys.
And thanks, Jonathan and the whole team for inviting me to present this paper. It's a joint work with Andrei Alexandrov from Tor Vergata University in Rome. He's also here. And it's an optimal unconventional monetary policy. So the emphasis is to study the mix between conventional and unconventional monetary policy in an optimal framework. That means with welfare analysis. So if you look at central banking traditional was all about interest rate setting, but nowadays, it's much more than one interest rate. So we have interest rate on excess returns, the policy rate, but we could in theory also set an interest rate on the required reserves, and we could also then change the required reserves. So we have the interest rates on excess reserves, required reserves, and the reserve requirements we can change as well. At the same time, on top of interest rates, we can also manage the balance sheet. So in particular, we can buy long-term bonds, you put it on the balance sheet of the central bank and issue them more reserves in exchange of it, or the other way around. So there's a huge of balance sheet management as well. So the central bank can take on some duration risk, some interest rate risk. And more generally, then we have a generalized policy rule, not a standard Taylor rule where you just specify the interest rate. You have a generalized policy rule, which, based on the state variables of the economic system, which state you're on, you specify then you have the interest rate on excess reserves, the interest rate on required reserves, there is the required reserves themselves, how big are they, and also the maturity of the central bank balance sheet. Now, the question we want to study here is what role does each instrument play and how do they interact? And what is the welfare maximizing policy mix? And then we also say, what are the implications for the yield curve and the duration dynamics in the system? So if you think about very simple balance sheet measures, and you're all familiar with that, the way we do that, of course, we need a model where there's a household and production sector, so households and producers are the same in our setting. And then there's also some intermediaries. We need a banking sector in order to study balance sheet measures of the central bank. Central banks interact a lot with banks. So we need a central bank interacting with the intermediary sector. So the central bank in our setting has some long-term government bonds, issues some reserves, and then the intermediaries or the banking sector also has long-term bonds from the government, and the households can also have some long-term bonds. And the reserves issued by the central bank are held by the banks, and they also hold some equity stake or some risky claims, can be many risky claims issued by the household sector. And the household sector is also the production sector, so they operate firms as well. And what most importantly, what the banks do, they issue bank deposits. The bank deposits are then held by the households. The households, they hold essentially the deposits from the banks, some long-term government bonds, and then they operate some capital, some physical capital, machines, where they produce some output. And that's very risky. Of course, long-term bonds can also be risky. They have interest rate risk, but the long-term capital has some idiosyncratic risk in our setting. And some of this risk you try to offload by issuing equity or some risky claims towards the banks, which the banks then can better diversify compared what the households or entrepreneurs can do. So that's the setting we're trying to work with. And if you then think, what does it mean to do QE, for example? Meaning QE means the central bank is buying some long-term bonds. And if it purchases the long-term bonds from the households, the households, they cannot hold reserves. So the banks have to step in the middle. So the central bank essentially buys the long-term bonds from the households, and the households get in exchange, they get deposits from the banking sector. And the banking sector has to expand its balance sheet and hold in, they issue more deposits and hold more reserves in exchange of it. So that's essentially what a QE does when you buy long-term bonds from the household sector. If the central bank buys long-term bonds directly from the banking sector, then they just swap essentially long-term bonds for reserves. And that's just a swap between the central bank and the banks, and the households are not touched upon. But whenever you interact with the household sector, the bank's balance sheet expands by doing so. So what we want to do in this framework, we would like to study, interest rate policy, various interest rates, and also central bank balance sheet management, QE, QT, and so forth, in an integrated framework. And for this, we need a macro model, a macro finance model with the financial sector. I mentioned already, we have this banking sector. And also we would like to have a model with aggregate risk. So unlike many macro models where there's no aggregate risk, we think aggregate risk is very, very important, especially if you want to study yield curves and other phenomenons. And we also have a setting with idiosyncratic risk. So each of the households, entrepreneur has some idiosyncratic risk. And in order to connect it to the new Keynesian framework, we also introduce sticky prices. So we build on some earlier work I did with Julie Sannikov, the IT theory of money, and more recent work by Zhang Li and Sebastian Merkel, studying introducing the price stickiness in the setting. And what we argue, the main results from this framework is that if you look at efficiency or welfare maximum, there's two forms of efficiency: aggregate efficiency and distributional efficiency. And the aggregate efficiency can be implemented with the interest rate policy alone. So that's essentially when you just want to get aggregate efficiency, it's fine to just move the interest rates around. You don't, have to worry about the balance sheet measures of the central bank. But if you do a central bank measure like a QE and you take a lot of duration risk out of the bank's balance sheet into the central bank's balance sheet, or out of the household's bank's balance sheet in the central bank's balance sheet, then subsequently you have to make a much more aggressive interest rate move. That is, whenever the central bank takes duration risk out, the subsequent interest rate moves have to be much more aggressive in order to achieve the same aggregate efficiency outcome. So and that's why you probably saw when the Fed was doing QE, sucking out a lot of duration risk of the private sector, it raised interest rates very dramatically, but didn't do so much because the duration risk was taken out of the private sector. Now, that's the first result. The second result is if you add distributional efficiency, if you want that the risk is efficiently distributed and also you have some distributional effects to it, that actually pins down the optimal balance sheet. Because in the first, in aggregate efficiency, okay, if the central bank takes a lot of duration risk out, we just have to move interest rates much more aggressively. So there's a continuum of solutions to achieve aggregate efficiency. But if you also want to achieve distributional efficiency, there's only a unique balance sheet the central bank should take on. And rather than, many papers say, okay, you should actually move with QE and QT exposed, we say actually the QE or the balance sheet measures have a preparatory role. So you essentially prepare for the next shock. So you take enough duration risk out of the system or put it into the system such that the interest rate move subsequently is the right move for the aggregate efficiency. And because you have the right duration risk in private hands, the same interest rate move is also optimizing distributional efficiency. So there's two efficiencies you want to optimize. And, if you put your central bank balance sheet in the right position, then the same interest rate move, you don't know whether it's a positive or negative and how big it should be. That's still, depending on the next shock. But the same interest rate move then can optimize aggregate efficiency and distribution efficiency at the same time. And of course, the way it works when you move interest rates, of course, you change the price of the long-term bond. You have long-term bond fluctuations. And, the balance sheet policy impacts then the duration. To what extent it affects then the people in the economy, the private sector, or the banking sector, household sector, depends, how big this price movement is on the long-term bond, and also to what extent, I will go to this notation later on, to what extent this long-term bond and this duration risk is in the private hands. Okay, so that's what we're trying to do in this framework here. We want to characterize what is the optimal central bank balance sheet and what is the optimal interest rate policy at the same time. But the central bank, the balance sheet policy is more preparatory. So you prepare your balance sheet in such a way that when you have to make the interest rate move, you can optimize aggregate efficiency and distribution efficiency at the same time. And then we also show what are the implications for the yield curve. And I just show you a picture about the yield curve. So it's a continuous time model, you get a nice yield curve specification out of that. And that's just, different states of the world where there's, if you're in a boom phase, that's how the yield curve looks like. It's downward sloping. It is, has a little hump here and it's convex. If you're in a recession phase, then it's very much upward sloping and it's concave all the time. But for normal times, it seems to be upward sloping first and then a little bit downward sloping. So it moves around. So of course, this states are continuous amount of states. So here I just picked 3 states. But essentially, yield curve is hump-shaped. There's inversion during recessions and has some concave and convex components. Now about the literature, and I mentioned already the literature about the macro and finance model, what this model builds on. I would like to mention a few more. In particular, I would like to mention and honor Chris Sims for this famous paper, Stepping on a Rake. As you probably know, Chris left us this Saturday. And I would like to honor him particularly with this lecture. Then, of course, the other Hay and Krishnamurti have important contributions in terms of intermediate asset pricing. There are also many other money and banking models, which I only list some of them. Now, that's one branch of the literature. Another branch of the literature is the QE literature in macro. But most of this literature what they do is essentially the banks, they hold some bonds, and the bonds are subject to capital requirements or liquidity requirements. So they're constraining the banks. You take the bonds off the balance sheet and replace them with reserves, and the reserves are not subject to the capital or liquidity requirements. We don't have this mechanism these papers have. We focus very much on duration risk, so it's not a regulatory constraining element which is driving in our results. In terms of balance sheet management, QE and QT, and how it affects the term structure, of course, there's a literature like Vicinity and others with preferred habitat, which is very much consumption savings choice focused. Ours is more portfolio choice focused. So that's the difference to this literature. But many central banks use the Vicinity, Kern-Lennell framework to study, the effects of QE on the yield curve and so forth. And of course, we will also have some convenience yield in our setting. Convenience yield, there's a large literature on that, but of course, convenience yield in our setting will be on bank deposits, and that will be more specific the way we model that. And there are many transaction cost models, Beginow and others is one example. Now let me put the model on the screen. So that's it, the model in one slide. So as I said, so we have the balance sheets here, that same balance sheets I've explained earlier. So we have the households and the banks or the intermediaries. The intermediaries hold the reserves from the central bank, and the households, they operate some physical capital. That's the physical capital, let's say machines. And the productivity is A, so each individual household's productivity is 8. It's all the same for all the households. And a certain utilization of the capital, let's call it upsilon. So that's the utilization. They can work harder on this capital, run the machine hot or less hot. That's the utilization. With it, there's a disutility also from this utilization. So all the households have the same utility function. They all have log utility. They all discount the utility at the time preference rate of rho, and the bankers, the intermediaries have all of the same utility function. And they invest, they can take some of these output goods and a certain investment rate iota, they can convert it into investment in the capital goods by investing it. So what's the accumulation of capital? So the investment rate is iota. If the investment rate is higher, then actually capital is going up. So that's what's going on here. And if the delta is the depreciation rate, so the capital is depreciating rate of delta. If you don't invest, so this will be 0, then it just depreciates. And this adjustment cost function, it's a particular log adjustment cost function. If the adjustment cost phi is 0, then this is linear. And as phi goes up, it becomes more and more concave. That in order to give you adjustment cost, and Tobin's Q moves around because of this adjustment cost. But importantly, each of these households, there's a continuum of them, they have a Brownian shock to their capital. And you can think of this Brownian shock, some of the machines break down or can be rearranged in a more efficient way. You can think of this measure also machines in efficiency units. And so there's a Brownian shock, and that's idiosyncratic. So each household has its own Brownian shock, idiosyncratic Brownian shock. And that's, how large this idiosyncratic Brownian shock is, depends on the sigma tilde t. And importantly, there's a subscript t here. The subscript t says, it's time varying. So there are certain periods in time where there's a lot of idiosyncratic risk in the system. Everything is very risky right now. And there are certain periods in time where there's not so much risk in the system. Okay, so the sigma tilde is moving around. And how is it moving around? It's just moving around by this exogenous mean reverting process. So the sigma tilde is shocked by an aggregate Brownian. That's an aggregate Brownian without a tilde. And when this is a positive shock, sigma tilde goes up, and suddenly all idiosyncratic shocks across all the households, everything is much more risky. If this is negative, sigma tilde goes down and everything is less risky. And it's mean reverting to a long-run steady state of sigma tilde. Okay, so that's essentially, that's an important element how the world moves in this setting. So importantly, we assume this idiosyncratic risk is uninsurable. That means there are incomplete markets. You cannot trade contingent claims freely among the households for these idiosyncratic Brownian shocks. So they're subject to uninsurable idiosyncratic risk. Banks can help out on this. That's why they can issue some of this outside equity or these risky claims to the banks, but among the households, it's uninsurable. Now, what else do the households hold? The households also hold some long-term bonds. These are the long-term government bonds. They pay a fixed interest coupon rate. Of course, the price moves around. As the short-term interest rate moves around, the price of these bonds moves around. And the households also hold some deposits issued by the banks. And what's important about these deposits, if you hold more deposits, you have a lower velocity of the deposits, hence your transaction costs are going down. And I will come to this transaction cost here. So the velocity is new, and the transaction costs depend how high the velocity is. If you hold fewer deposits, you have to turn over the deposits at a higher frequency for as a working capital or as for consuming. Then you have some extra transaction costs showing up here. And as I said, these households issue some risky claims to the intermediaries. These are these outside equity claims. And what we assume is they pass on, not assume, this will be an endogenous choice, will pass on a fraction chi of the risk to the intermediaries. Okay. Now let's go to the bankers or the intermediaries. They hold these risky claims. They hold some reserves from the central bank. The reserves are enumerated, in a sense that there are excess reserves and required reserves. They might have a different interest rate. Then they get the long-term bonds. They have capital gains and losses on the long-term bonds and get the coupon rate. And they issue these deposits. Now, the big assumption we make is that when the households issue these claims with this idiosyncratic risk, the bankers can diversify it, but not perfectly. They can only diversify it up to a fraction var phi. So let's say it is 10%. So 90% they can diversify away, but the remaining 10% they cannot diversify away. The way we model that is that all the banks get another Brownian, and there's essentially 10% of the risk they take on. If they take on more of these outside equity risky claims, they have to have more. They have also more idiosyncratic risk on their own across the banks. So that's idiosyncratic across the banks. I should say there's a continuum of banks. So the banks are perfectly competitive. There's no market power in this sense that they're not competing with each other. Then we introduce sticky prices a la Rothenberg. So there's quadratic adjustment cost functions there. That's just a standard New Keynesian feature. And in order to capture all the New Keynesian, we have this New Keynesian monopolistic competition block for good differentiators. So there's an intermediary sector, goods intermediary sector, which differentiates the goods in order to do all this New Keynesian block. But that's very standard. So there's nothing new compared to the standard model framework. What I want to study here is constrained efficiency. So we have to, when we say about optimal monetary policy, you said, oh, what's optimal? What's our efficiency benchmark? So we suppose there's a government which raises taxes over time at a certain flow rate in response to aggregate shocks. So I should say there's no market incompleteness with respect to aggregate shocks, the aggregate Brownian, but the government or the social planner cannot ensure idiosyncratic risk. Okay, so there's no artificial advantage the social planner has. It has the same frictions as the market economy faces. Okay, that's what we call constrained efficiency. So there's the idiosyncratic shocks. The planner can also not insure against each other. So the economy behaves as a planner that can freely set essentially the aggregate efficiency elements and the distributional efficiency, but cannot ensure idiosyncratic risk. So let me just say what the aggregate efficiency, you can think of this as an output gap, the traditional New Keynesian way, but there's a static component to it and there's a dynamic component to it. Now, what's a static component? It's the capital utilization rate, how much capital is utilized at what speed. This is a different way. You can also think as labor, some effort choice you put in. If you utilize the machines at a faster pace, at a higher utilization rate, you have to have some disutility from utilizing it higher. And that opens up as a static output gap. But of course, you can also affect the investment rate. If you invest at a lower rate, that means capital is building up slower down the road. So there's a dynamic output gap opening up as well. So these are the aggregate efficiency policy variables are mostly, or not policy, the choice variables are upsilon, this in utilization rate, and investment rate iota. Now, what's a distributional efficiency? You have to think of what's distributed. So we have to distribute risk. So who holds what risk? So distributional efficiency is of idiosyncratic risk. How do we distribute risk? This is this chi. We'll come to that. And how do we distribute wealth and consumption? I mentioned that all our people have log utility. So with log utility, consumption is just the time preference rate rho times net worth n. So the distribution of wealth and distribution of consumption is the same. And that's essentially distribution we call eta. So that's the net worth of the whole intermediaries with a superscript I over the net worth of the whole economy.
Hi, Markus. I have a question about efficiency. Is it efficiency in a Ramsey sense, or is it efficiency in a time-consistent sense? Does it matter in this framework?
So here we assume it's in the Ramsey, so it's time. So you commit essentially upfront. So also when we introduce the policy rule later on, it's you can commit to a policy rule. That's a good question. Yes. So, but we don't introduce some time inconsistencies. There's no time consistency in this framework, but it is the planner commits ex ante to a certain policy or a certain choice of these variables. But what's important is the planner chooses the utilization rate, the investment rate, and then from a distribution side, okay, how should I distribute the risk across the households? So this is how much risk is held by the banks and how much is held 1 minus chi is then what's held by the households. And it says, so how wealthy, what share of the total wealth goes to the bankers, and 1 minus eta is the share of the wealth which goes to the households. And then I also have the distribution of wealth across assets. So what are the two assets? We have all the machines, the physical capital, that has some value. And then we have all the government liabilities. And the government liabilities are reserves from the central bank, because if you consolidate it balance sheet, the reserves are liabilities of the central bank. And then there's the long-term bonds. So these are the government liabilities. That's written in nominal terms. So these reserves are in nominal terms. This is also long-term bonds in nominal terms. I've divided by the price level, divided by the total net worth. And as I said, the total net worth is this liabilities of the government plus the physical capital, the value of the physical capital. So let me outline what is the planner's objective. And then, you know, as I said, the planner should maximize these variables over time as we move over time. So of course, that's the utility or the welfare of the intermediaries with intermediaries, and that's the welfare of the households is going on. So as I said, they all have log utility, and they are discounted at the time different discount rate of rho. That's the same for both of these type of agents. And we put the Pareto weight lambda on the banks and a 1 minus lambda Pareto weight on the households. And as I mentioned earlier, the households consume, of course, their share of consumption is 1 minus eta. The share of consumption of the intermediaries is eta. And then there's, of course, each individual household, individual intermediary, I call eta tilde. Okay, so this is the share of all the bankers, all intermediaries. But then I have to take, of course, also each individual banker or intermediaries is different. That also moves around. Their wealth share within the intermediary sector, I call eta tilde. The wealth share within the household sector, so there's a total consumption of the household sector. But then what's the share of each single household? It depends on the wealth share of the household within the household sector. That's I call eta tilde h. Okay, and as I said, the utilization, if you utilize the capital at the higher rate, they get some disutility from that. So that's the welfare objective for the planner or the social welfare planner, and is maximizing it over this. And of course, there are certain constraints this planner is facing. So we assume that he has to obey Tobin's Q. That comes from the adjustment cost in the investment function, given the investment rate. That's the QK is determined this, so it's like Tobin's Q. If the price of capital is higher, that's the price of capital, then actually you will convert more consumption goods, sell it the machines at a higher price to the market, and then there will be more capital stock. So if the price of machines goes up, the investment rate will be higher, and because of our log specification, it takes on this nice linear form here. Now, what's about the consumption? so this is the consumption rate per unit of K. So this C, that's why it's multiplied by K. The output is, as I said, that's the total capital stock with capital letters. The utilization, so it's the total output giving the productivity A, that's the total output of, let's say, apples, whatever we're producing, minus what I use, the investment rate times K. That's essentially for, I take the apples and plant them to get new capital stock in the next instant. So that's essentially goods market clearing condition. And once I replace the iota, I can rewrite it this way. But what's important is that how does the risk of a single, the well share of a single intermediary move around? That's the shock of this individual Brownian, which is a particular individual intermediary. And for the households, it's another. So these are actually, there should be superscripts on it. These are different Brownians, the individual Brownians for each individual. And of course, that depends how risky the environment is. It depends how much they can diversify. If our phi is 10%, so it's only 10%, the households don't have this 10% here. And then how much risk they're having. So the risk share, if the risk share of the intermediate is higher, so there's more risk on them, that's the risk share of the household, so 1 minus chi. And then there's also this element, that's the fraction of wealth, which is physical capital wealth. So I should say var theta was, perhaps I go back, var theta was the fraction of wealth, which is government liability of total wealth. So that's the var theta. So 1 minus var theta is actually a fraction of wealth, which is physical capital wealth. And you know, the only capital is shocked by the idiosyncratic. Government shock is not. That's why we have to multiply by that. And that's the wealth share of all the bankers together. And this is the same here, just and you just 1 minus eta because it's the wealth share of the households. Okay. So that's the planner's objective and subject to constraints, so we can solve that. It's a complicated animal if you look at it. You know, it's because it has all this infinite horizon on all this going on. But what's nice about this problem, once you plug it in, you can actually see, and that's due to log utility as well, that essentially you can get a myopic solution. So you can actually, or put it differently, rather than solving this whole problem dynamically, that you constantly have to dynamically solve it, you can actually solve it time by time, by each instant. So if you solve each instant, you can solve independently. It's not coupled what you have to solve next instant. Okay, so rather than having this integral over dt, I can solve it instant by instant going through the whole system. Now, that means these integrals are falling away. I just solve each thing separately by solving it one by one because it's not interconnected. I can actually simplify the problem. So it becomes just this problem. And also what I do is I plug in these elements here. And so I get and plug in the constraints. And then I can rewrite the welfare on a particular point in time. What I maximize has the following feature. So this is a log that you can see here. That's total consumption minus what I invest per unit of K. That's one thing. Then there's a disutility from utilization. That's only for the households because the bankers don't utilize, they don't use our utilization. So that's 1 minus lambda, the weight, Pareto weight of the households. Then there is the growth rate of capital, which comes from the investment rate minus the depreciation, the adjustment cost function here, that actually boosts welfare. So if the capital stock grows faster, I expect in the future to go up. And that's aggregate efficiency. So that's the aggregate efficiency. It depends on the output of consumption goods, which I can really consume. So total output minus investment, the disutility from utilization. And so that's my aggregate efficiency in a static sense. And then, of course, I affect the capital stock, which determines the efficiency going forward, because if I have a higher capital stock, I will produce more in the future. That depends on this iota. That's the aggregate efficiency. And that's typically what we look at in many of these macro models. But now I also have to say, is it also welfare optimal? Is the consumption and the wealth, distributed the right way across the agents? So if I have a Pareto weight of lambda on the bankers and a Pareto weight of 1 minus lambda on the households, then it will be the case that there's the log utility showing up. So essentially, I would like to pick an eta wealth share And the planner can do this. How much wealth goes to the bankers and how much wealth goes to the households? He just picks a wealth share of lambda. Okay, so if the Pareto weight is 10% goes to the bankers, 90% goes to the households, then also the wealth share should be 10% and 90%. So if this were the only thing, then that's what the planner would like to do. But of course, there's also some risk, some disutility from holding risk. And that's what this last term comes in. So that's my disutility because of a minus term. Now the question is, how is risk distributed and who is holding what risk? And that's what this chi shows here. So chi, that's the risk held by the intermediaries, given the wealth share. And that's the risk held by the households, 1 minus chi, given the wealth share of the households, 1 minus eta. And we put also Pareto weights on this. But importantly, you know that the bankers, they have this ability to diversify idiosyncratic risk away. So they can diversify it away. So this phi is the 10% squared. So it just makes this much smaller. So what the planner wants to do is, okay, I should not give, if the Pareto weights are 10%, and 90%, I should not give 10% to the bankers and 90% to the households. I should actually push some risk onto the bankers. So he wants to pick a chi, which is larger than the Pareto weight of the bankers. And he can push more risk on them if you also bring some wealth share over to the bankers. So he also wants to push eta towards the bankers. So he might want to give the bankers more than 10% of the wealth share. Just to give you the intuition, that comes all from this small phi here. Okay? So the constraint efficient allocation we denote with a star. So that's essentially, as I said, the epsilon, the utilization rate, the investment rate, and then that's from the aggregate efficiency. And then how we distribute risk, how we distribute the wealth share or the net worth share, and what VAR theta we pick. And the VAR theta essentially shows up here. So VAR theta is how much of the wealth we put on the government liabilities relative to the wealth of the to the physical capital or total wealth. Let me know if there are any questions. Now, the optimal allocation, I actually gave it already away, essentially is that, if you put the bankers, you give them a lambda Pareto weight, let's say 10%, the wealth share the planner would like to give to the banks or to the intermediaries is actually more than 10%. Why? Because, I can push more risk on them. I can even push more risk on them if you give them more wealth share. And I will push, let's say we give 20% of the wealth to the bankers, and we give 30% of the risk to the bankers. Okay? And that is, of course, then it's smaller than the whole thing. So the Pareto weight, even though the Pareto, I only care as a planner for 10% weight goes to the intermediaries, I give them more wealth, and I push even more risk onto them because they're better in sharing risk, in diversifying risk away compared to the households or the individuals who produce the household individuals. Okay.
Markus, excuse me, it's Antoine again. Just a question, maybe something I missed. So here your variables are only a function of the underlying level of risk, not the actual realization of the Z or the DZ in your framework?
No, the underlying risk, the DZ, the aggregate risk, and the idiosyncratic risk, the DZ tildes, they all affect evaluations. Because the aggregate risk is also affecting the evaluations. So the evaluations is, I say, how much value to attach to the physical capital, QK, the price of a capital unit, and how much value do attach to the government liabilities, which consists of reserves and the government bonds. Right now, I treat them together. I will open them up in a minute, but these are all the government liabilities. Did this answer your question?
Yes, thank you.
So perhaps it becomes clearer. So essentially, put yourself in the shoes of a private agent, let's say a household. You can say, what is my wealth? My wealth is the physical capital there's a price to it. And that is, of course, affected how much idiosyncratic risk is on it, but also how risky is the whole environment. That's the aggregate risk. That's time-varying idiosyncratic risk, essentially, how the time varying of how much aggregate, how much does this move around. And then I also have some long-term bonds, and I have some indirectly through the banks, I have some reserves. All of this is essentially wealth the private sector is holding. And the question, that's the total wealth. And while theta is actually a fraction of wealth, which is the government liabilities, and 1 minus var theta is the physical capital, which is a productive producing wealth. So let me just say, so that's essentially the welfare, what the planner tries to do. And essentially what we are saying and what will be in proposition 1, what proposition 1 says, and I indicated this already, if the Pareto weight on the banks is lambda, the wealth share is actually larger. And the utilization, there's an optimal utilization, but it's a constant. So as sigma tilde moves around, suddenly we move to a risky environment, the utilization still stays the same. If we move to a less risky environment, the utilization is also the same. So there's an optimal utilization, which is constant. So there's no drift in utilization. There's no volatility in utilization. It doesn't load on some aggregate Brownian. It's just constant all the time. Now, the investment rate is moving around. So if you move to a more risky environment, suddenly capital becomes more idiosyncratically risky. We actually want to scale back. The planner wants to scale back investment rate. Okay, we will see later what the market will do, unregulated economy, but the planner would also like to scale back the investment rate. Now, that's in terms of aggregate efficiency, the utilization and investment rate. In terms of how I distribute wealth and risk, if the idiosyncratic risk is actually going up, we move to a much more risky environment, then it is the case that the wealth I give to the bankers should go up, and the risk I assign to the bankers with the optimal risk share assigned to the bankers is also going up. And finally, the share of the wealth, which is from the government liabilities and not from the physical capital. So while theta is a share of the wealth, which is the government liabilities, the long-term bonds and so forth, that actually is also increasing with sigma tilde. Let me show you a picture. So here I think that's probably more illustrative what's going on. So let's suppose I just shock the sigma tilde, it's an MIT shock, and then it decays this way. So we live in a very low risk environment, and suddenly idiosyncratic risk goes much more up, and then it drifts back down to the initial level. These are the changes in sigma tilde. Now I said the planner would like to have the utilization of capital constant. So the change in utilization is actually, so all of these are in changes of utilization. The change in utilization is not changing at all. It stays the same. But as idiosyncratic risk goes up, that makes running physical capital or machines more risky. I don't want to produce so many machines. QK is going down, the price of a machine. So the investment rate is also going down. So the planner also would like to bring the investment rate down, and then it drifts back. So these are all very intuitive what the planner would like to do in an economy. Now, what's the share of the wealth, which is government liabilities, money like reserves, plus long-term bonds, that actually is, the planner would like to push up. Okay, so, or put it differently, if it's a share of the wealth which is due to machine wealth or physical capital wealth is going down. Okay, so that is, this share is going up. But importantly, the planner would like to make the intermediaries wealthier in terms of share of wealth in times of high volatility. Okay, so when you go in a recession, there's a lot of idiosyncratic risk floating around, a high risk environment. The planner would like to give the wealth share more to the intermediaries, to the bankers, and give less wealth share, lower wealth share to the households. And he also would like to assign a higher risk share to the bankers. Okay, so you can see, okay, essentially what the planner wants to do is when there's a lot of risk, and the bankers are good risk managers, they actually can diversify some of this risk away. I would actually push the risk onto the bankers because that's what they're good at. They're good at risk sharing. at diversifying risks. That's what the bankers are good at. So when there's a lot of idiosyncratic risk, I want to push some risk onto the bankers, more risk onto the bankers. But of course, they will be very unhappy. They still have this VAR residual risk, so they're still unhappy. So to make them less unhappy, I also give them a higher wealth share. Okay? So that's essentially what the planner does. So typically, said, oh, the planner cares 10% about the intermediaries, and he says, okay, but they're very good in diversifying, so I give them more wealth. Then I can also push more risk onto them, and they're good to diversify this risk away. And that also helps the households as well, because they can offload this risk, this idiosyncratic risk, towards the bankers. Now, when the idiosyncratic risk goes up, this channel becomes even more important. So the planner wants to push more risk onto the bankers, so the sky goes up. But then the bankers will be very, very unhappy, and so it's okay, I compensate you also with a higher wealth share, essentially. Okay, so that's what the planner wants to do. There's no market, nothing going on. That's the planner solution to this problem. Now, the question now is, let me now contrast this with what the laissez-faire economy does. So it's an economy without monetary policy. So let's just run the economy the same way. It's not the planner solution, but the laissez-faire economy. So it's like the economy acts as we have described it and set it up, but there's no government intervention. Okay. Of course, I can talk about output gap, which is the output relative to the optimal welfare optimizing output. That's just given by this. That's utilization. Utilization might be deviating. The capital stock might be deviating too. So the output gap in log terms, there's a deviation in utilization. Utilization might be too low relative to the optimal utilization, but also the investment rate might be lower. So there might also be the capital stock in the long run. That's the dynamic output gap I talked about earlier. Now let's say what the laissez-faire economy does. So I do the same shock. So the blue and the yellow line are on top of each other. That's why you only see the yellow. That's the initial shock. So suddenly we move to a much more risky environment going on. Now the planner said, I don't want to move utilization at all. In this competitive laissez-faire economy, utilization is dropping off and then comes back as the risk decays. And you can also see the investment rate is also dropping off much more significantly in a laissez-faire economy relative to what the social planner would like to do. Okay, all of these things just say the big thing is there's an output gap opening up. The planner doesn't like an output gap, but there's an output gap up, an instantaneous output gap opening up, and a dynamic output gap opening up because the investment is falling off much more. That means the capital stock will grow in the long run much less, so it will be in the future less output. Now, let's look at these distributional variables. So here is the first very striking thing. So the striking thing is actually in a laissez-faire economy, the risk share, which is held by the bankers, the planner would like to, in times of high risk, would like to put a higher fraction of the risk onto the bankers, onto the intermediaries. But the laissez-faire economy does exactly the opposite. Okay, so there's less risk held by the bankers in times of crisis. And one reason for that is that actually the wealth share, what the planner would like to do is the planner would say, I give you a higher wealth share in times of crisis. So the times of crisis, the wealth share goes up, while here it is the case that actually in laissez-faire economy, the yellow one, the wealth share of the bankers is going down. And you can see that that's also what I've depicted here. That's because of a flight to safety. You can see there's some flight to safety into the government liabilities, into US treasuries or into reserves. The value of the reserves relative to total wealth is going up, and you can see it's going up, and that typically hurts the bankers. Why is that? Because the bankers essentially, they're levered. They have a lot of deposits, demand deposits on the liability side, and the real value of the deposits increase in times of crisis. And so they're losing out in terms of wealth share. So the question now is, can we fix that? So with monetary policy, and what instruments do we need to fix it? Okay. So that's what the plan is. So let me just summarize again. So what we did is we said, okay, let's first solve the planar solution. We just have a welfare characterization. Because of log utility, we can break the dynamic welfare problem into, we can solve it period by period. That makes it much simpler. So we can solve it explicitly and say, oh, that's a blue thing. And then we say, okay, let's do the market economy, the laissez-faire economy without any monetary policy or any intervention, and say what's going wrong. And what's going wrong is, of course, utilization opens up, investment drops much more, and actually the risk distribution is going exactly in the opposite direction. The world's distribution is also going in the wrong direction. And there's still flight to safety, but these things are going in the wrong direction. So can we fix this with the right monetary policy? So let me just summarize. So there's some externalities. There's some sticky prices. There's an instantaneous output gap. That's because of sticky prices, a new Keynesian element. And then there's some aggregate pecuniary externalities. So agents don't internalize the link between the portfolio choice. So there's a portfolio choice var theta. How much do I put my wealth into the safe assets from the government versus the capital, the physical capital with idiosyncratic risk, and the investment rate. There's a link, and they don't internalize that as a group. They affect the capital price, which then feeds back into these linkages. And then there's some distributional pecuniary externalities going on as well. Now what I want to do is essentially, I've characterized the planner's problem, I've characterized the laissez-faire economy, and because of pecuniary externalities, the laissez-faire economy is, there's things are going wrong. And now I would like to use realistic policy instruments, not a planner which can pick directly the utilization and the risk allocation and all that. I would like to set some interest rates and do QE and QT and balance sheet measures to implement that. And to give you the punchlines, once I set this up, what the realistic policy is, I can show we can still implement the planner solution by doing the right monetary policy, conventional and unconventional. So here now we have to assume what instruments do we allow the central bank and the fiscal authorities. Okay, so we have to split up the central bank and the fiscal authorities. So we say essentially the central bank can set some interest rate on excess reserves, it can set some interest rate on required reserves, and it can also change the reserve requirements. So essentially what the central bank can do is says, okay, I set the marginal interest rate, which is the excess reserves, and I can also change the intramarginal interest, the average interest rate. Okay, it can change the marginal, which then affects all prices in the economy, but it can also set the inframarginal interest rate by setting the required reserves. This way, you can also redistribute from the banking sector to the household sector in this sense. So it issues reserves, the central bank, based on aggregate shock and the aggregate Brownian. You cannot set reserves, issue new reserves based on idiosyncratic Brownians, the continuum of them across all the households and the banks. But it can act conditional on the aggregate Brownian, and it can also have a drift in the growth rate of the reserves. And it can hold bonds, and how many bonds it holds is LCB, and that also is, you can be conditioned on the aggregate Brownian and has a certain drift. Okay, so that's what the central bank can. And the key difference to the fiscal authority is the fiscal authority can issue some new long-term bonds, and these are long-term bonds, let's say bonds which are mature, never mature console bonds for simplicity. And the fiscal authority can only issue new bonds, the L fiscal, with a certain drift, but there is no DZ term. Okay, that's the assumption we make. The central bank can react much more quickly to an aggregate shock and condition on the DZ term. The fiscal authority cannot do that. And the bonds pay an interest, a coupon rate of IL, and they're traded at a nominal bond price PLT. Okay, so these are the long-term bonds. And of course, the fiscal authority can also impose taxes on this, but nothing can be conditional on this DZ thing. Okay, so in a sense, central banks can react conditionally on the next macro shock, the fiscal authorities cannot react to the next macro shock. They can only adjust the drift subsequently, but not immediately at the same shock. And the argument here is the motivation is that when a fiscal authority issues new bonds, you have to wait for the next auction of new government bonds being auctioned off, while the central bank can constantly interact with open market operations and buy some long-term bonds and sell long-term bonds in the exchange of reserves. Okay. And this can be conditioned on this macro shock. Okay. So in terms of long-term bond holdings of the private agents, so there's some long-term bonds are held by the intermediaries, there's L superscript I. Some long-term bonds are held by the households, L superscript H. So the private sector as a total is holding L in our notation. And this is what fiscal authority issues, LF, minus what the central bank buys. Okay, so LF minus LH. So what we care about essentially out of these bonds which are held by the private sector, what fraction is actually held by the intermediaries that we call eta L. Okay? This is a different eta. This is now superscript L indicating what fraction of the long-term bonds is held actually by the intermediaries out of the bonds in private hands. And of course, you can see if the central bank buys more of the long-term bonds and the fiscal authority doesn't do anything, the total number of outstanding bonds is going down. So the L is changing. Now, so we focus here on the interest rate and the balance sheet policy of the central bank. Of course, the fiscal authority might still operate in the background. I will ignore that in this talk. So what the central bank can control, it can of course move the interest rates around, but it can also move around what share of the long-term bonds in nominal wealth is held in private hands. So in particular, you can say, I buy long-term bonds, I take duration risk out, and or I sell long-term bonds in exchange of reserves and push duration risk into the private hands. Okay. Now, so this var theta L is different from this var theta. Var theta was a fraction of wealth, which is government liabilities. Var theta L is a fraction of the government liabilities, which are long-term. Okay? So the government liabilities are the reserves and the long-term bonds. That's the long-term bond times the price of the long-term bond. Reserve, the price is just one, a nominal price. And that's the value of the long-term bonds in private hands divided by what's in private hands of all government liabilities, which includes the reserves. Okay, so that's, and it can change this by swapping these two things. Of course, the denominator is not changing, but this thing is changing. So the var theta L is moving around. Okay. And essentially, by moving the interest rate, you move the price of the long-term bond. So the volatility of the long-term bond, if you move the interest rate, you move the price of the long-term bond. So that's going on. But how much is in the private hands? That's the var theta L. Okay. So you might move the long-term bond a lot, but it's mostly held on the central bank balance sheet. It doesn't really affect the private sector then. Okay. So the price of the long-term bond is just the discount that you have the interest rate here. The coupon rate is IL, and then you have discount, you have the policy rate, and then you have a risk premium on it as well. And that's, I won't go into why the risk premium is this. I think what's important is the total risk. So this whole denominator I call also this fancy B. So the volatility of this fancy B consists of the volatility of the long-term bond times the fraction of the long-term bonds which is held by the private sector. Okay? And the other part is held by the central bank, but that's not in the private hands. So I can actually push by changing var theta L. I do QE, I suck out duration risk. So var theta L is going down. By doing QT, I push more duration risk in the private hands. Var theta L is going up. And then, of course, multiplied by the volatility of the long-term bond price, that gives me the whole risk exposure of the private sector on this government liability script B. So let me first focus on passive balance sheet management. So I hold this var theta L, constant. And I was thinking, how can I implement can I implement aggregate efficiency? So aggregate efficiency, remember, this was utilization, the instantaneous output gap, and the investment rate, which was dynamic output gap. Can I implement that? Do I need QE for this or balance sheet management? And I will show you don't need it. Okay. Only if I really want to do the risk allocation and the net worth allocation, then I need the distributional efficiency. When I want to get this as well, then I need the balance sheet management. Now, this essentially is the goods market clearing condition. So that's the total output multiplied this by capital K. And that will be total output of all goods. Some of them is invested. And then the consumption is also written by rho times net worth. Some of this net worth is the physical capital, and some of this net worth is from the government liabilities. So believe me, this is just rewriting the goods market clearing condition. Now, the planner has an optimal utilization, that is epsilon star, and an optimal investment rate. Now, can I implement this by choosing this thing here appropriately? Okay, so I have a certain utilization, which I would like to implement from the planner's optimal solution, a certain investment rate. So if I choose this appropriately, I can actually hit the target epsilon, and I hit the target, the investment rate target. Okay. And what you can see is that whenever I'm shocked, the macro shock hits and the sigma tilde moves around, these things move around. So this has to be the optimal thing for any sigma tilde as sigma tilde moves around. So I have to make sure that this also moves around with sigma tilde in an appropriate way. With this, the sigma drives the sigma tilde here. So when there's a shock, the sigma tilde moves around. The sigma tilde moving around has implication on the long-term government bond, and how much it affects then the sigma B depends on this was theta L. This was this duration risk in private hands. Okay, so I can actually do this in two ways. I can actually make my interest rate move more aggressively. This means the bond becomes more volatile, so this is actually higher. Then I don't have to push so much duration risk in the private sector. I can take duration risk out. So if the duration risk is out, I do a lot of QE. A lot of long-term bond is sucked out of the system, put on the central bank's balance sheet and replaced with reserves. This doesn't change here, the denominator. But then if I want to implement the same thing, I have to be much more aggressive on my interest rate policy. So this response of the long-term bond has to be sharper, and I have to move my interest rate more. So essentially what you have, you pin down the sigma B. All what you have to make sure that the sigma B is correct. And whenever the sigma tilde moves around, that this volatility is right in order to still hit the two targets. You have to make the volatility of this thing move the right way or move the right amount. You can achieve this in two ways. If there's very little duration risk in the private sector because you sucked it out through QE, you have to move your interest rate a lot in order to make this term high. Or you can also do it another way by saying, okay, I do QT, I push a lot of duration risk onto the private sector's hands, then I don't have to move the interest rate so much. Or put it differently, a larger central bank balance sheet means a smaller duration risk in the private hands. I need a more aggressive interest rate policy. Okay? And that's, of course, a continuum of solutions. I can, whatever I do the central bank balance sheet, the optimal interest rate policy subsequently to hit these two targets is determined how much duration risk is still in the private hands on this for theta L. Okay, if I suck out this duration risk, I have to move the interest rate much more aggressively. If I push it onto the private sector's hand, I don't have to move the interest rate so much. And I can achieve the optimal utilization, the optimal investment rate. That's all about aggregate efficiency. This was only one component of the welfare optimum. If I don't care about how is the wealth distributed and how is the risk distributed. Now, if I now care about the distributional efficiency, okay, on top of the aggregate efficiency, now I also have to make sure that actually the right eta, the right wealth share, and the right chi is implemented. So I have to also want the chi, the risk share, which is with the banks versus the households, and the wealth share would have the optimum. To also implement the optimal thing here, and also the optimal var theta L. Remember, var theta L was the share of the risk which is with government liabilities, 1 minus 1 theta L is the share of the risk, which is with the machines. Okay, so that was this component. And I won't have the time to go into that, but if I want to do that, then I actually have to manage my balance sheet. I cannot do it by just keeping the balance sheet in a particular way, and there's no continuum of solutions. Then the balance sheet is pinned down to the optimal balance sheet. So I move my balance sheet in the optimal way. The optimal duration risk is on the central bank, and the rest is in the private sector. And then the interest rate move, which I need for my aggregate efficiency, is also then the optimal for this distributional efficiency. Okay. So let me just, so the change in the wealth share has, of course, a flight to safety. If there's a, idiosyncratic risk goes up, the world becomes more risky. The bankers, there's a flight to safety going on. That's a flight to safety term. Then there's a direct effect. So then I do something with the interest rate. I cut the interest rate, let's say. How much this affect the bankers' wealth share depends on how many long-term bonds the banks are holding relative to their wealth share. Okay, so if they have a lot of long-term bonds, cut interest rates, the value of the long-term bond is going up, so the wealth share is actually stabilized. That's a positive effect. So there's a direct revaluation effect from the revaluation from the bonds. It's related to, of course, Chris Sims stepping on a rake to some extent. But here it's a redistributive effect. And then there's an indirect GE effect coming up on top of it because G affects these settings. But the interesting thing is to capture this direct effect. But notice the bond holdings in the banks versus households. That's what this eta L is. That's an endogenous thing. Okay, so who is holding these bonds? To what extent are held by the households, and to what extent are the long-term bonds held by the banks? This is an endogenous thing that I have to make sure that this is held the right way. So, for example, in the middle, scale down the bond holding if they get more if the price volatility of the long-term bond goes up, because the long-term bond is a risky thing, and if it's very risky, then the middle scale down the bond holding. Okay, and so I have to make sure the bonds are a relative anti-hedge for intermediaries. So if the volatility of the long-term bond goes up, the volatility of the net worth share is going up too. Okay, so they have the same sign. It goes in hand. So I have to make sure. So let me show this in pictures. If I care about the distributional efficiency, that's given here. So I have the volatility. I can pick the volatility, and I have to make sure. So or put it differently, I have to make sure I have the right holding of the long-term bonds of the bankers relative to the households. And so I have to look at their portfolio choice. That's the red line here. As I change the volatility of the long-term bond, that's the holding of the banker's long-term bond. That is the optimal portfolio choice. And then there's the optimal distributional choice for distributional efficiency in order to achieve this distributional efficiency that again satisfy that. There's two equations, and essentially I have two solutions here. One is a reasonable solution. The other one is more extreme. That's for distributional efficiency. And then I also have on top of it the same picture as before. I have some aggregate efficiency, which is this yellow vertical line. Okay. And what this yellow vertical line does is it just shows you, the bond holding that is not for the aggregate efficiency. We didn't have any households or bankers bond holdings going on. That's why it's a vertical line. But if I do QE and QT in the balance sheet measures in its total, this moves this yellow line back around. Of course, it moves the other two lines as well. And in order to get the optimal policy mix, all of these three lines have to coincide with this. So I have to pick my optimal central bank balance sheet such a way that all these three lines are on top of each other. So let me, and I should
Markus?
say, yes?
Yes, I just have one question about this figure, because if I understand well, so the optimal per nominal wealth volatility is determined by the intersection of aggregate efficiency, distributional efficiency, and portfolio choice conditions, right?
That's correct. So all of these three conditions have to be, if you want total efficiency or welfare maximum, all of these three have to be coincide essentially. Here, this figure it does not. No.
Yes.
So we have
so
to
my
move the
question
theta
is,
L. We still have to move it around in order that all of three of them are aligned.
so economically, which one of these curves is doing the real work? I mean, if you shock the portfolio choice block only, I mean, would the other two blocks
let me
move?
put it this way. So if I make this more volatile, I move essentially along both. I move the portfolio choice, I might change. So if I make the long-term bond price more volatile by making interest rate movements more radical, okay? The bankers don't like the bond anymore. The portfolio choice goes down. They like it less and less and scale back on the bond holdings, long-term bond holdings. More is held by the households. Okay, that's the red line. There's also an optimal distributional efficiency, what I would like to have in order to get this optimal chi allocation, risk allocation, and data allocation. That's this blue line. That is essentially this equation here. If I hit all the targets here, I plot the hit, I want, and then I solve for this as a function of the sigma PL, which is how aggressive is the interest rate movement. Then I get this blue line for a particular fixing theta L. Okay. Now that's, how much QE, QT happened. Now I say in the next step, and I say I just plug in aggregate efficiency. Okay, if I pick this point, I have distributional efficiency, but I don't have aggregate efficiency. Okay. If I want aggregate efficiency on top of it, I have to move the var theta around. So move this yellow line, it becomes this new yellow line here, or this one here. So I have to move it over here that everything hits at the same time. Of course, once I move the yellow line, the other two lines will move too. So, but ultimately I have to find the point so that all of these three lines are crossing each other at the same point. And so this is moving along this line is making interest rates more aggressive or less aggressive.
Stay the portfolio choice, the policy message.
So this is moving along this line. I make interest rate moves more radical or less radical, more dramatic or less dramatic. That's moving along this thing. Moving the yellow line, making from this vertical line to this, I have to change the balance sheet. Okay. The central bank balance sheet, may put in more long-term QE or QT. Does this answer your question? Or I say it again. Before I move into yellow line here, that's the same thing. I can actually make the long-term bond be more volatile or less volatile. That means how much do I make my short-term interest rate move around? When there's a shock, do I move very radical interest rate ups and down or not? That makes my long-term bond more risky or less risky. If I don't move much, the long-term bond is not so risky. Then the banks are happy to hold a lot of long-term bonds. If I make the long-term bonds move around a lot, the banks don't want to hold too much of the long-term bond. So the eta L is actually much lower. Now for distributional efficiency, there's an optimal point such that the banks have to hold the optimal amount in order to hit the optimal levels here. So I want to have an optimal eta L. And this is essentially that point. Here, the portfolio choice is right, and the distribution, I achieve also the optimal point. So I have to make my interest rate moves aggressive in such a way that the sigma, the volatility of the long-term bond is, in this example, is 8.3% or whatever. Now, this is only achieving distributional efficiency, holding QE and QT in the balance sheet of the central bank fixed. Now, if I say, for this fixed balance sheet, do also hit the aggregate efficiency? No, because the aggregate efficiency is held on this level. So I also have to change the var theta L. I have to move var theta L around that actually the yellow line is also going down here. But that pins, once I move the var theta L, of course, these other two line curves will also shift. So I have to essentially solve three equations and three unknowns to solve the whole thing. So I have an optimal balance sheet and optimal interest rate aggressiveness. Okay. Great. Thanks. So for the holdings of the bonds, actually, these transaction costs play a big role, and I just want to emphasize briefly this transaction cost. I pushed them a little bit aside so far. Remember when the banks issue deposits, the banks are good. They're actually good in diversifying. That's what they are good at. But they also create demand deposits, and demand deposits are valid because there are more demand deposits in the system. They lower this transaction cost. It's a medium of exchange roll of money. Okay, they create essentially money. Demand deposits have a money feature. If I didn't have these transaction costs, if they were always zero, the bond and the deposits would be able to perfectly share the risk. And so the central bank has no control over the wealth distribution. Now, if there's transaction costs, then the deposits have a convenience yields because the deposits are money, while the others are just stores of value. The deposits are stores of value and medium of exchange. And so the bank says, okay, I'm willing to take on some additional risk and issue more deposits because people are willing to pay more for these deposits, or they hold it at the low interest rate. There's a convenience yield on it. So I want to produce more of these deposits. I can benefit from that and deviate from optimal risk sharing. And then the central bank can essentially, because of this, the central bank can affect the wealth distribution. If the transaction costs are zero, actually they're perfectly risk share, and then you cannot do anything. So let me put it in different words. If you were to do a policy which redistributes, people can anticipate and can just contract in such a way to undo the distribution. So let's suppose, so here the social planner, what's important, does not want perfect risk sharing. Remember, perfect risk sharing would be the wealth share eta would not move around. That's perfect risk sharing. But the planner wants that in bad times when idiosyncratic risk goes up, the wealth share of the bankers and the intermediaries goes up and the wealth share of the households goes down. He doesn't like the perfect risk sharing. So how do you make sure that the bankers, to get away from this perfect risk sharing? It's very hard because if their contracts can be traded, they will just share it. But if the bankers get a convenience yield from issuing deposits, that actually breaks this perfect risk sharing, and that actually makes then the wealth distribution by the central bank powerful to implement the first best, or so there's the constrained second best. So we need a certain form of segmentation or these transaction costs to go on, but not perfect segmentation. So it's the right thing of segmentation you need to hold. Let me just, I know I'm running over time, say a few words about the yield curve. So I mentioned this already. So this, the low sigma states, this is when there's not so much risk in the system. That's essentially a boom phase. Everything is low risk. People are willing to hold a lot of physical capital, produce a lot of output. And that's when the yield curve, of course, the low sigma tilde will drift back to a higher sigma tilde. In the future, the world is good right now, will be worse in the future. So yield curve is actually downward sloping. But in high sigma tilde case, where now it's a very risky time, everything is depressed, production is depressed, consumption is depressed. It will on average, it improves in the future. The yield curve is upward sloping, and in steady state, the yield curve has this shape. You can also say what would be the yield curve under the expectations hypothesis. So I switch off the volatility of the intermediary's net worth equal to zero. So that's the risk premium. If intermediaries hold these long-term bonds, they want the risk premium, and it depends how much volatility is in their net worth. If I were to switch it off, I would get these dashed yield curves here. But I don't really have to time to go into that. But if you have under the expectations hypothesis, this would be the yield curves showing up in this setting. So let me summarize, and sorry for running over. So what we wanted to do in this setting is to study the optimal monetary policy mix of conventional and unconventional monetary policy and go beyond a simple one interest rate moving around. We have several interest rates, and in particular, we have the balance sheet measures. It's not driven by zero lower bounds. We don't have no zero lower bound in the setting. In order to study QE and QT, you need a banking sector because most of the QE and QT goes through the banking sector. With other banks, you can't do it. And you also would like to understand it in a world where there's some aggregate risk in the system and also idiosyncratic risk. And that's what we try to do it. And we say, okay, there's some aggregate efficiency, very traditional New Keynesian output gap, instantaneous or static and also dynamic because of the growth rate of the capital stock subsequently, and distributional efficiency. How is the risk distributed? in the economy, and how is the wealth distributed in the economy. And what wealth fraction is on the government liabilities and what wealth fraction is in the household liabilities. And what we're saying is that a larger central bank balance sheet requires more aggressive central bank intervention in terms of interest rate policy. If you do QE and you suck out all this duration risk from the private sector, to do the same impact subsequently, you have to move the interest rate much more aggressively. And the more QE you do, the more aggressive your interest rate policy has to be. That's the case if you only care about aggregate efficiency. Now, if you care about distributional efficiency as well, then you have to, in advance, you have to push the balance sheet already in the right position such that the same interest rate movement, which you need for this particular balance sheet to make aggregate efficiency, is also optimal for distributional efficiency. So that pins down a unique balance sheet duration on the central bank versus on the private hands. In this sense, an optimal usage of the balance sheet management is preparatory. So you bring your balance sheet in the right positions and over the next interest rate move, I don't know it's positive or negative, but it will hit my aggregate efficiency and the distributional efficiency, both things. And this, of course, once you do this optimal thing, it has implications how the yield curve looks and how you would like to manage. Essentially, by doing this, you manage the yield curve as well. And it turns out to be this hump-shaped yield curve structure.
So thank you very much again. I have one question or two, but feel free, others, if you want to, if you have any questions, raise your hand. So I will ask just one question, and after I will give the floor to Tabiso. Okay, so my question is more about the heterogeneity between the government and the central bank. So central bank has his own rules, and some governments could do things that are not really, that could be extreme, in the sense that they can have more debt, and the central bank has more flexibility at some point, or sometimes less. So how do you assess this wedge between the behavior of the central bank that could be more flexible, that could be more rigid? I mean, in other words, it depends on which country we are and which government behaviors we have. So, and I did not see this in the model. So maybe you have your own opinion about how it could enter the model.
So what we don't have, so we don't have, it's one country model. So we don't have a heterogeneity across countries in a sense. But of course, it depends a little bit on the financial structure as well. So are you in a country where there's a lot of duration? So let's say a mortgage. So I'm moving now beyond the model, okay? What is the mortgage market situation? So how much duration risk is actually in the household's hands because the mortgage market is signed in a particular way, and how much duration risk in the banking sector? I don't have a mortgage market in this setting. And this, of course, says, okay, the duration risk, let's suppose is let's work flexible mortgages, duration risk is mostly in the households and it's offloaded from the banking sector. Then I have to, my QE has implications on that, because in a world where the duration risk is mostly in the banking sector and the households are protected because they're fixed mortgages, then it's mostly in the banking. So I have to take this into account as well, because then I play much more with the banks by doing QE. And in the first setting, I play much more with the households. Is this what you're after? Just to make sure.
Yeah. I mean,
so
exactly.
Here in this model, we had only a productive sector. We didn't have, a housing sector and mortgages and all this. But this would actually also enter, and it will also reflect the analysis. But this would further complicate the model. Here we just wanted to illustrate how important it is. Well, let me ask differently. I'll tell you differently. The Fed was at the end, there was raising the interest rate by 400 basis points or 4 percentage points. And everybody said, oh my God, why did it not do something dramatic? But QE took out a lot of duration risk. And hence you had to move the interest rate very dramatic in order to get inflation down. Okay. If they would have left the duration risk, no QE, left it in the private hands, they didn't have to move the interest rate so dramatically, or the same interest rate move would have been much more dramatically for the real implications. And one reason why it was not so dramatic was because they took duration risk out. Now, I should also say, of course, it also depends a little bit on the fiscal side as well. The US Treasury was issuing a lot of long-term bonds as well. So you have to take all of these things into account within the model, is reduced to, what the fiscal authority is changing the hands of long-term, short-term. We didn't move this much. So what really matters is how much duration risk is in the private hands. And that's affected, of course, by the monetary authority, by doing QE or QT, but also affected by the issuance of the fiscal authority. Do they issue a lot of long-term bonds or a lot of short-term bonds? This you have to aggregate if you go to calibrate this model.
Mm-hmm.
There was another question.
Feel free to raise your hand if you have another question. I just continuing because why I asked this question is because a couple of minutes ago, you told me that to reach the optimal points, then the central bank has to be super reactive. But central banks cannot take very strong decisions on interest rates. And I will not talk about the smoothing or stuff like that. But maybe some part of the policy of the central bank have more restrictions. Maybe some parts of government policy has more restriction. And this is not, it's more free in your model, which is good. And I agree.
Yes, the model allows you to be more reactive or less reactive. So it's true, the model allows you, but in the real world, you have more constraints in a sense.
Exactly. Yes.
So you have to take this into account, of course, in the real world. But here in the model is, okay, I do a lot of QE, I take duration risk out, and then I have to be very reactive on my interest rate policy. And the model does not say, oh, this might blow up some other things in the financial sector or something. Mm-hmm. So that's why you say, okay, when I do this, I don't want to do too much QE, because if I have to then step on the brakes with an interest rate move, I have to be very reactive. So then I'm ex ante, I'm more careful how much QE I do if I have these additional constraints. Because I know QE means being more reactive interest rate policy subsequently when something happens. And so let me be more calm, not so much QE, because I don't want to be too reactive subsequently if there's an inflation spike.
Okay, thank you very much. Do we have any other questions from the attendees? Okay, I will, yes, Evangelos Travelas.
Yeah,
Evangelos?
Thanks for, hello, and thanks for the opportunity to ask this question to Markus. I have a remark and a question which drives me to a conclusion, if I may. Your paper shows that the balance sheet policy plays, let me say, a preparatory role, and there is a significant substitutability between the instruments. If I follow correct this logic, this may imply that there may not be a fixed menu policy for the central bank, but a dynamic evolving set. Now, I might be wrong to drive me this conclusion, but this may suggest that there may be a policy hysteresis in a sense that two economies with the identical fundamentals may reach different outcomes with different stories may reach different policies and outcomes. And this makes me think that the monetary policy effectiveness becomes endogenous, and it has to do with the geometry and the institution architecture types of the country, and it has to do with institutional reforms. Is this interpretation consistent with your framework? And if so, should central banks manage their policy space as case-based resource analogous to fiscal space? Thanks.
Yes. So very good question. So let me say it this way. If you only care about aggregate efficiency, then there's substitutability. You can do a lot of QE if you say later I do much more reactive interest rate policy. If you care about aggregate efficiency and distributional efficiency, distributional efficiency is essentially almost like a constraining thing. So then you have to say, I move the central bank balance sheet in such a way that subsequently the interest rate policy is not only doing the optimal thing for aggregate efficiency, but also distributional efficiency. And so in this sense, distributional efficiency is a constraining thing. And as Jonathan mentioned earlier, that it could be, it could be another constraint, some other institutional constraints, which make it think. But you're right with the subsidiability. Now, the fiscal authority here, I did not change the debt level of the government debt situation all that. So of course, this can also change in the background. And in a sense that if the fiscal authority says, okay, we issue only long-term bonds, dramatically long-term bonds, and the central bank says we do QE, so we buy the long-term bonds and issue short-term reserves. It's as if, almost as if the fiscal authority were issued T-bills short-term government bonds. So in a sense, you have to always take the aggregate, the consolidated balance sheet between the fiscal authority and the central bank together to see what is the maturity risk, or the duration risk in the hands of the private sector. That's what this model essentially says. So we don't, so that's essentially what matters is the duration risk in the private sector. And then you have to also make sure that it's distributed the right way between the banks and the households. Okay, that's the other thing you have to balance with.
Okay, thank you very much. Do we have any additional questions from attendees? I will just ask my regular question. So you are a central banker and you have this paper. What would you do? I mean, what would you change? Let's say, take for example the Fed, because I assume you know better the Fed than the Bank of Israel, but what would you do?
So I would do the following. I would be aware that if the QE, I have to move interest rates potentially much more aggressively, and I would be more hesitant to do aggressive QE movements or QT movements. So, and I would also think about, this paper gives you a way to think about what is the optimal central bank balance sheet, how big should it be, and in particular, how much maturity risk should be on the central bank balance sheet. And this is also in connection on the maturity of the the treasuries outstanding or the government bonds outstanding. That determines, so if you want to think about what optimal balance sheet should the central bank be, how big should the central bank balance sheet be, and what maturity risk should be on the central bank, this paper will give you some guidance in this sense. And also on the dynamics, if I load up a lot of maturity risk on the central bank, I subsequently have to move interest rates a lot. And that also means I make a lot of losses on the central bank balance sheet. And I can go beyond the papers and, this gives me some headline risk down the road, because I will potentially incur a lot of losses on my own balance sheet that might politically backfire and also hinder my, my independence. But monetarily interpreted, it gives you some indication on the size of the balance sheet and the duration risk on the balance sheet, and what does it imply if you subsequently have to raise interest rates more aggressively, and whether you like this or not. Probably not. So I would be more hesitant to do a lot of QE. Yes.
Okay.
Yes.
Thank you very much. That's a nice, I mean, your last sentences are very interesting in the sense that if you establish direct link between the government behavior and the central bank behavior, then you have a kind of losing independence. I mean, if you establish a mechanical link, and then the government could play with it to manipulate the central bank, and maybe the opposite. So
yes, this goes a little bit beyond the paper in a sense, but of course, if you put a lot of duration risk on the central bank, what the central banks, if you look at the Fed or the ECB, they have a lot of duration risk loaded on the balance sheet. Now they had to hike interest rates and they made huge amounts of losses. And they, of course, carry these losses now over for the next 10 years. That, of course, undermines, so there's no independence threat in this model now, but that carries some headline risk, and that undermines political independence for the central banks to some extent, or there are more concerns about that.
I see. Okay. Any other questions from the audience? So I think we are good. We were a bit longer, but that's very interesting presentation. No, it was very interesting. Thank you again, Markus, for having been with us and presenting us this fantastic paper. We wish you a lot of success with it, and we hope to see you again with another policy relevant paper like this one. Thank you very much.
Okay. Thanks a lot to everybody.
From Juan.
I appreciate. Oh.
No,
Yes.
he did
And
not.
stay safe.
Thank you very much. Have a nice day. Yeah,
Yes.
thank you. Thank you very much.
Bye-bye.
Cheers. Bye-bye.